Hello and welcome again. Welcome to video number 5 in the financing, capital budgeting and investment sequence. And in this video, I will be talking about the concept of market beta and capital asset pricing model. We will be discussing beta in class at length. This is one of the most important concepts in the first day of our lectures. So what does beta mean? Let's say we have a market beta of 0.73. So formally, beta is the regression coefficient of excess return on the market risk premium. Basically, if the market index, such as S&P 500, Standard & Poor's 500 index, if it goes up by 1%, this stock is supposed to go up by 0.73%. Consequently, if S&P 500 goes down by 1%, stock with this beta will go down by 0.73%. So it doesn't quite move as much as the market index. So this would be an example of a defensive stock. On the other hand, let's say that we have a beta equals 3.2. This is an example of a very aggressive stock. It performs exceptionally well when market is doing fine. For every percentage point that the market gains, it should gain 3.2. The problem is that it turns into a dumpster fire when the markets are beginning to go down. We'll lose 3.2 percentage points for every percentage point drop in an index. So, how do we use this information to formulate our pricing decisions? So let's say that we do have these two stocks. I'll use the same numbers. So let's say we have stock with beta of 0.73. Again, I'm just picking fairly random numbers. And this stock with a beta of 3.2. Remember, we do not care about total risk. We care about systematic risk. And this systematic risk is beta. It's how much your stock co-moves with the market. I am thinking of adding this stock with a beta of 0.73 to my already well-diversified portfolio. And if my portfolio is very well diversified, it will be very close to market portfolio. And market portfolio will have a beta of 1. Because, well, its correlation, its regression, its correlation with itself is 1. At the end of the day, if you're holding market portfolio, well, that's market portfolio. When I add this stock, what will happen to my portfolio volatility? It will go down, because this is a defensive stock, less volatile than the market. Well, no prizes given for guessing what's going to happen to my portfolio volatility when I add this stock. It's extremely aggressive, extremely volatile stock. Portfolio volatility up. Okay? Do I like this? I do. This is a good thing. Portfolio volatility down. I'll draw a happy face here. A sad face here. Will the demand for this stock be high or low? Well, it's a good stock. It's a good stock that I like, that I really want to add to my portfolio. It will have high demand. On the other hand, the stock here will have a very low demand. Well, flashback to economics. High demand, high price. Low demand, low price. High price, low return. Why low return? And this is important. This is sometimes a bit counterintuitive. The more you pay for something, the lower return you're going to realize. If you want to realize a high return, if you want to make a killing, you need to buy that something at a low price. High price, low return. Low price, high return. Look, and this applies to different characteristics of assets. If it's a good, high quality asset, why on earth should it pay you high return? It shouldn't. It's a good asset. You will hold it simply because of its high quality. If it's an asset with some bad qualities, such as very high beta, or maybe a bond with a call feature, or some weird covenant that you don't really want, the only way for me to buy that asset is if it offers me some discount, if it goes for a high return. So, in the context of capital asset pricing model, low beta, low return, high beta, high return. I hope this makes sense. So the logic that I use in this chain is portfolio diversification logic, adding an asset, a stock. It doesn't actually have to be stock. We can compute beta for other asset classes. But the key here is the impact on portfolio volatility. All right. Let's take two special cases. Let's say that stock A has a beta of 0 and stock B has a beta of 1. The next key question here is this. What should be the expected return on stock A? And what should be the expected return on stock B? Pause this video for a second and think about the answers here, because if you get the answers right, that means you should have no trouble for the rest of this block course. Now, according to this security, stock A, has no systematic risk. It does not co-move with the market at all. Zero beta, zero correlation with the market. And remember, since systematic risk is the only risk that we actually care about, we basically assume that the stock has no risk. What return should it have? Well, some people say that it should be 0. It will not be 0, it will be a risk-free rate. How much risk does stock B have? Its beta is 1. It means that it co-moves with the market perfectly. It has the same risk as the market index. Therefore, it should have the expected return on the market. It should have exactly the same expected return as the market does. This is the law of one price. We have talked about it in economics. When two assets are equivalent, they should cost the same. So, I have my beta, my systematic risk on my horizontal axis. I have my expected return on my vertical axis. So stock A will be here, 0 beta risk-free rate. Stock B will be here, beta of 1, expected return on the market. And that's it. We got 2 points. We can draw a line. We can draw our security market line using these 2 points. Every asset in equilibrium should be on the line. And this is what portfolio managers and security analysts around the world do all day, every day. They're trying to find the assets that do not belong on this line. What is the equation? Okay. So the expected return on your asset will be intercept, RF, plus beta times rise over run. Rise, run is just 1. That is my capital asset pricing model equation. My expected return is the risk-free rate plus beta times the market risk premium. So, just to give you a bit of context here. So, what on earth does this mean? How can we actually use this equation? Let's say that my risk-free rate is 1%. And let's say that my beta is, I will use an easy number, 0.5. And let's say that the expected return on the market is, well, let's say 6%. What should be the equilibrium return for this stock? Well, it's 1% RF plus beta 0.5, RM 6% minus 1%. So we have 5 times a half, 2.5 plus 1, 3.5%. The equilibrium return of this stock is 3.5%. If it's higher, I should rush and start buying it. If it's lower, I should be selling it. Of course, in real life, things are a little bit more complex than that because we deal with issues of how to actually estimate beta and the market risk premium, and we will be talking about that in class. Thank you for listening, and I will see you in my next video.